can I have too much stock in my portfolio? Would this like cause me to have a lower chance of success in the long run?
Yeah, so this is actually a question that came up in a strategy session with our clients. And this is really interesting. It revolves around the situation of, how much money should I have in stock for my particular retirement? And it's kind of fascinating. It doesn't always, translate to make sense. So I'm going to share my screen here and we'll take a look at kind of an example I made. Um, and so this is what we call finding a retirement path. This is all part of this whole component. We think this is super important. So education is part of that. But really part of a retirement path is how much money should I have in stocks or bonds, throughout my retirement. And so it's kind of fascinating. Here's what I'm going to show you for an example. Very simple. This is a financial plan, lots of information behind the scenes. I'm going to give you the high level piece. So here's a portfolio, 58% stock. It got a bond and cash are the other two pieces in there. And the projected average rate of return on this is 7.7%. This is from Money Guide Pro's financial planning program. And so what we would do then with that particular mixture, we could run Monte Carlo simulation. And so I'm going to push this button here in just a second and basically, run their financial plan 1,000 times. So just to understand behind the scenes, we have these assets, we have inflows, Social Security, and those types of things that'll be coming in someday. And then we have outflows for things that they need to have to live off of. And so when I push this button, it's going to run their financial plan 1,000 times and see how many times it works. And it allows the computer to randomly choose amongst the different variables. And it's supposed to replicate your life by running it enough times. Kind of the average is what you're looking at there. So once I go ahead and push this button, there we go. All right, so this is what you end up with, is this big, green spaghetti, so to speak. And so for this particular sample, we have 930 successes out of 1,000 different tries running through this Monte Carlo simulation. So that's a 93% success ratio, which is very good. Anything above 85%, in my opinion, is very, very good. And so at the 58% exposure to the stock market, this plan works quite well, right? So not bad at all as far as that goes. But just to show you kind of a difference and something I think is interesting, what if we, what if we move that same portfolio into a scenario where we know the stock market's going to fall, right? So this is what we call a stress test. So here we had a 93% success ratio, but if we run this again with one known variable, is that we're about to have a stock market crash. In this case, just like the Great Recession loss. If you remember, for the Great Recession loss, started in 2007 actually, but most people look at it as 2008. We ended up with a 57% drop in the S&P 500. The percentage loss for this portfolio is projected at 23%, but you can see their probability of success drops all the way back to 56%. So obviously a big stock market downturn is something to be concerned about in this particular situation, and we have strategies for what we would do with that. But I just want to compare that to a different mixture. So here now we're going to take that same plan and assign a much more aggressive portfolio. So here it's 96% stock. The other 4% is just money in the banks, basically. Average rate of return is expected to be 9.74%. So if you remember, the previous one was 7.77, so almost 2% more per year. Theoretically, that should work better, correct? But it doesn't. And so if I now click on this one, same parameters, I just changed the portfolio, it drops back from 93 to 89%. So even though there's a higher average rate of return, the success ratio dropped back by 4%. And the reason is because we just added more volatility to the overall portfolio. And when you run that through 1,000 times, there's going to be some of those times where the stock market just does so terribly that you end up with a situation of failure, where you can see these red ones across the bottom here, and that's when basically the money ran out before you did, which is obviously not ideal. Still not bad at 89%. That's still higher than my threshold of 85, but it's not as optimal as the 58% portfolio where we had a 93%. And it's kind of exaggerated by the fact that if we run the stress test and reevaluate this thing with a Great Recession coming, we drop back to 13% success ratio, which is really, you're running out of money at that point. And that's why there's more red situations in there. And obviously you can see that, it has a 49% projected drop in the value of the portfolio. So that, again, lots of things happening behind the scenes and what have you. But that's a really critical component of what we're looking at as far as that goes. And so overall, I think it's important to, use this tool to try to figure out what we're going to do. And one of the biggest questions we get, and we're trying to answer that sort of here now, is how much, stock to use in the portfolio. And so what I do is I'll run that Monte Carlo simulation, 20% stock, 40, 60, 80, 100. And, usually I come up with a range. Like I say, okay, the optimum, success ratios for you in your situation seem to be 40 to 80% range, or 20 to 60% range, or whatever it might be. It's different for everybody. And even sometimes the higher, the 80 and 100% is optimal depending on your parameters. But what we're trying to point out here is that higher rates of return and higher risk don't always relate in every case to a higher probability of success throughout retirement, because there's just too many other things that can come into play there. So I think it's a great way to look at it. It's very interesting. But to answer that question, yeah, you have to be a little bit careful about, just adding more stock with the thought process of, hey, more stocks make more money, but they also have these big periods of time where they can make less. And if you're living off of them at that point in time, that could be a problem.
So what happens on the emotional side? Some people, you know, they can't handle, it just feels so slow, or like the returns are so low when they do 60/40, but because they're so used to the 100% model,
Yeah.
even though it lowers their success chance, would you stick still at that 100% model? Would you maybe go in between the two? Is like, how do you balance that, like, emotional side versus that just the pure numbers?
Yeah, pure kind of analytics. It's a good point, Easton, because really what happens here is that the emotional side actually dominates the analytical side in the end. Because it's one of the things I learned about with the 2008 downturn. We can go through a planning process on an analytical side, say, hey, you should have 80% in the market. But then we have a big drop and people are selling out at the bottom because it really didn't meet their emotional needs in terms of how much risk you were taking. And you're exactly right. It can actually go the other way too, where you've got 40% exposure because that's what the model says you should have. And people are dissatisfied during a big upturn and they're constantly wanting to move up. And obviously, sometimes they move up at the wrong times, right? Right at the end of the big run. So, one of the things that we really look at there ever since 2008 is we really try to point out, what the average rate of return was on the upside, so you can see, hey, and then what you might have lost, on the downside. And we specifically will look at the 2008 downturn and kind of model that. So, somebody knows, hey, I might lose 30%. I think they just need to be comfortable. It does help to know the range that's recommended by the plan. That's a piece of the puzzle. But in the end, it's really about the emotional side. So we try to grab the emotional side by showing kind of the extremes, how much it can make in a good market and how much it can lose in a bad market, and make sure that they're comfortable with that range. But in the end, emotional people throw the plan out the door when they're nervous, or what have you, as far as that goes. So I've seen more people having too much risk in their portfolio over the years than not enough. That doesn't come up as often. Usually it's a fear factor that comes in. And so anyway, that's a good question. It's a good point.